If you've been trading options, you must have heard about what we call LEAPS, Long-Term Equity Anticipation Security. It's a type of option that I wanted to cover in this video because there are some great advantages in using LEAPS, but there are also some risks that you need to be aware of. And it's very important that you understand both sides when we talk about LEAPS. I want you to understand the good side, but also the bad side, the negative sides, because you'll see that it's not only a good thing. Personally, if I had to choose a team either for LEAPS or against LEAPS, I'd be absolutely for LEAPS. However, it's important to be aware of the risk that you have when you're trading LEAPS, so hopefully you can make the best decisions for yourself in your trading if you want to use LEAPS. But before diving into this video, if you find this video interesting or helpful, please consider subscribing to my channel and liking this video. It's the best support you can give me and I'd really appreciate it. But first of all, let's talk about what are LEAPS in the first place. What are those long-term equity anticipation security? LEAPS have been introduced in the 90s and they are options that have an expiration of more than a year. So any option that has an expiration that's going to expire in more than a year is considered as a LEAP, as a long-term equity anticipation security. And that basically summarizes what are LEAPS. It's just an option that has a very long expiration. There is nothing more complicated than this. Either it's a call, either it's a put, but if the option has an expiration of more than a year, then it's going to be considered as a LEAP. But why is it so great? Why are people loving LEAPS? What are the reasons for that? And one of the reasons that people actually love using LEAPS is in terms of buying power reduction. When you buy LEAPS, you are not going to put as much money as you would put on the table if you were buying, for example, 100 shares of the stock. Let me give you an example so it's completely clear. Let's imagine that right now you want to buy 100 shares of Apple. If you wanted to buy 100 shares of Apple, the current stock price is around $121 per share, something around this. Then that would cost you $12,100 just to buy 100 shares of Apple. So far, so good. But if instead of buying 100 shares of the stock Apple, you decide to go for a LEAP. And let's pretend that we go into the June 2022 expiration, so it's around 440 days to expiration, so it's longer than 1 year to expiration, so that's considered as a LEAP. And if we decide, for example, to buy a LEAP at the 122 strike, that would cost us around $17 worth of premium, meaning that we would need to pay $1,700 worth of premium because one contract controls 100 shares. So if the premium is of $17, then the real premium, the real price to buy this contract is going to be of $1,700. You need to multiply 17 by 100 shares. So essentially, to control 100 shares of Apple, you could either buy the 100 shares of Apple directly, or you could also buy a LEAP. However, you must have noticed something that is really interesting here. On the one hand, if you buy 100 shares of Apple, then you're going to have to spend $12,000. And if you buy the LEAP that we just covered at the 122 strike, then it's only of course, going to cost you $1,700. You can see that there is a massive difference between the two. And still, on the one hand, when you buy shares, you control the shares, of course, because you just bought them. But if you buy a LEAP, you also control 100 shares because one contract controls 100 shares. And you only paid $1,700 to buy that LEAP when you will have paid $12,000 to buy the 100 shares directly. So you can see that there is a major difference in terms of buying power required. You don't need nowhere near $12,000 just to buy the LEAP. You only need $1,700 to buy that LEAP. So it makes a buying power reduction when you buy a LEAP that is quite crazy when you think about it. And to be exact, you're essentially doing a buying power reduction of 85% by buying that LEAP at $1,700 compared to buying the shares at $12,000. You're paying 85% less just to buy that LEAP and you still control 100 shares of the stock Apple. So you know, you can see that there is a really big potential in terms of buying power reduction. You're not going to pay as much as if you were going to buy 100 shares of the stock directly. So that's an amazing advantage that LEAPS have. They're going to save you a lot of money compared to actually purchasing 100 shares of the stock directly. You can buy a LEAP and save 85%, for example, of the buying power that you would have needed if you have wanted to buy 100 shares of the stock. But where is the catch? Because obviously, you know, if I tell you that you need to only pay $1,700 compared to $12,000, then where's the catch? There's obviously something that we don't understand here. It's not only free money that we're giving you. The thing is, when you buy an option, you're going to be subject to what we call the time decay, meaning that every day that passes, options lose a tiny bit of value, and the closer you get to expiration, the bigger the time decay. So you can see basically with that graph that you see now, that is a representation of the time decay as we get closer and closer to expiration. So you can see that first, there is really not a lot of time decay, meaning that the erosion of the options value is really not going quick. However, as we get closer and closer to expiration, you can see that the time decay curve is getting exponential because there's more and more time decay and options are losing value a lot quicker. So that's the disadvantage, that's the risk in a way when we talk about leaps, is that they're subject to the time decay. So for example, let's imagine that you buy shares of Apple. If the stock tanks and you just hold to your shares, you're not going to lose money in terms of time decay on a daily basis. If you just hold your shares, the stock could come back up and then you could end up in a profit. Compared to buying a leap, if you wait for example a year and the stock hasn't recovered, your option is losing value day after day after day. And let's say that the stock hasn't recovered in like 300 days, then you're going to be in a pretty bad position because the leap will have lost so much value because of the time decay that you'll be in a loss. However, if you understand what you're doing and you start looking at the Greeks and for example Theta, the time decay, or Vega, or for example Delta and Gamma, we can start really getting into some interesting stuff here. You see, in an option you have what we call intrinsic value and you also have extrinsic value. If an option is in the money, then it's going to have intrinsic value, and any option that is out the money doesn't have any intrinsic value. It only has extrinsic value. And what we see is that the further in the money you go, the less extrinsic value you're going to see in the option. Meaning that if you, for example, go for an option that is very deep in the money, it's going to cost a lot of money, it's true, but it's going to be mainly intrinsic value and very few extrinsic value. But you'd probably ask me right now, why is that important? Why does that matter that there is a few extrinsic value when it's deep in the money, or that there is a lot of intrinsic value? Well, there is one very big particularity, is that the time decay is going to affect the extrinsic value of options, meaning that the closer you are to expiration, the more the option is going to lose value on a daily basis. That's the time decay, we get that, we understand that. However, it's the extrinsic value that is going to be eroded by the time decay. So if we know that, and if we decide, for example, to go for a leap that is very deep in the money, and because we know that options that are very deep in the money have very few extrinsic value and mostly intrinsic value, then in that case, all the price that we pay to buy that leap that is very deep in the money is not going to be affected too much by the time decay. Because the thing is, as there is very few extrinsic value, the very small part of the extrinsic value that we're going to purchase when we're going to purchase that leap option that is very deep in the money is the small part that is going to be affected by the time decay, compared to the majority of the option value that is mainly intrinsic value. So it means that if you're buying a deep in the money option, it means that you're not going to be as affected by the time decay compared to if you were buying an at the money leap. And there's something that I want to show you here so you can fully have a visual explanation, because sometimes just talking about it isn't enough. And I want to show you exactly visually what is the extrinsic value and what is the intrinsic value so it's completely clear for you. So right now we are in the TestWorks platform and I want to show you the difference between extrinsic value and intrinsic value visually. So if we look at the option chain right now that I have in front of me, this is the option chain for the June 2022 expiration, as I was just talking about earlier. If we look at, for example, this column, so you see that this column is the ask column, meaning that if you buy an option, the net price will be the ask. So let's just pretend for the sake of the example that we're just going to purchase at the ask price. If we decide, for example, to purchase the option, what I said, around the 122 strike, then it's going to cost us around $17 worth of premium, so $1,700 in total. Compared to if you go deeper in the money, you can see that the ask price is going to increase a lot. You see that, for example, if we go for the option that is around the 90 delta, so it's at the 80 strike, you see here, it's going to cost us $43.90 of premium, so almost $4,400 worth of premium. So you see that compared to the at the money option that we were paying before at $17 worth of premium, $44 is a lot more compared to what we were paying before. Before we were only paying $1,700 and now we're going to pay $4,400, a big difference. But that's where it really gets interesting. If we look at this column, the extrinsic value column, so the one that is within this red rectangle. So the extrinsic value column represents how much extrinsic value there is within the total premium, within the ask. For example, we were talking about the 80 strike, so this strike. And we said that it was costing us almost $4,400 to buy that leap. If we look at the extrinsic value that is within those $44 worth of premium, we see that there is only $1.35 worth of extrinsic value within those $44 worth of premium. Compared to if we look at, for example, the 120 strike, as you can see here within that red rectangle, you see that the ask price is of $17.55, meaning that if you were purchasing that leap right now at the 120 strike, you would pay $1,755. And if we look at how much extrinsic value there is for that particular leap, you see here that there is $16.30 worth of extrinsic value that make up those $1,700 worth of premium. It means that within those $17.55 worth of premium, there are $16.30 of extrinsic value, and the rest is intrinsic value. So what does that mean? Well, it means that there is a lot more extrinsic value for the at-the-money strikes compared to if we come back to our deep in the money strikes, where we could see that there was only $135 worth of extrinsic value out of the $44 worth of premium, out of the $4,400 worth of premium. I hope it makes sense, and if it doesn't, it just means that the deeper in the money you go, the less extrinsic value you're going to purchase when you purchase a leap option. And why is that important? It means that the less extrinsic value you're going to buy, the less value you're going to lose because of the time decay. And that's something that you can really see quickly. If we, for example, click at the at-the-money strike where we were before, at the 120 strike, you see that we're going to lose $1.85 per day. And that number is only going to increase as we get closer and closer to expiration. Compared to if we go back to our 80 strike with the $43.90 worth of premium, so almost $4,400 worth of premium, you see that the theta, the time decay, is of $0.89 per day. You see that you're losing significantly less money by buying that deep in the money call. And know that the extrinsic value is essentially the maximum that you could lose by the time decay, meaning that at worst, you're going to lose $135 worth of extrinsic value because of the time decay if, for example, you have to wait a very long time. So in the end, it makes sense, for example, to buy a deep in the money leap option because you're going to suffer less from the time decay. You're going to pay less extrinsic value. So on a day-to-day basis, you can afford to wait a lot longer because you're not going to lose as much value because of the time decay compared to if you were buying an at-the-money leap option. Then you would be crushed by the time decay and most of the option would be composed of extrinsic value, and that is going to hurt you on the long term as you hold on to that option. That's why when someone says that the time decay is one very big risk of leap options, it's true that it's a risk, but if you want to counter that risk, then you go deeper in the money. However, know that the deeper in the money you go, the more premium you're going to have to pay so as to purchase that option. Of course, there's no free lunch. If you want to be less affected by the time decay, you're going to have to pay more premium overall. And if you want to pay less premium to buy that leap option, then you're going to suffer a lot more from the time decay. So you see that there is always a balance to have, and there is no free lunch, never. There is never a free lunch, and you always are going to give up something so as to get something else. That's how options work. But of course, don't forget that you can lose money if the stock goes against you, meaning it's not necessarily about time decay anymore. If, for example, you buy a call leap option and the stock completely tanks, then you're going to lose money anyway. The time decay is only going to be a small player. But if we talk about, the small differences between deep in the money options and at the money leap options, there are some pretty big differences, which are, for example, in the time decay. There's going to be less extrinsic value in the deep in the money options. That's why if you want to limit the time decay, then it might be better to go for a deep in the money option when you want to buy a leap. The second big advantage of leap options is when we talk about cost basis. So the cost basis is basically you buy 100 shares of a certain stock, then your cost basis is going to be your cost per share. And as you sell options, you're going to collect premium, you're going to collect profit like this. We said that it's going to reduce your cost per share, your cost basis. And that's, for example, the premise of the covered call. The covered call, you buy 100 shares and then you start selling buying calls against those shares so as to reduce your cost per share. And that's why we say you're going to reduce your cost basis, because you're collecting premium, and that is going to help to reduce your current cost per share. And there is an alternative to that strategy, the covered call, which is called the poor man's covered call. We call that the poor man's covered call, but it's also called the diagonal spread. And essentially, instead of buying 100 shares of the stock, you're going to buy a LEAP option. And now you can start understanding why it's quite important to understand the extrinsic value and how it works, and how does the time decay affect the option value. Because now that you understand that, if you want, for example, to go for a poor man's covered call, then you're going to pay less money by buying that LEAP option. If you go a bit deeper in the money, you're going to suffer less from the time decay, and essentially it's going to help you tremendously in reducing your cost basis. And I want to show you that visually, because this is really important stuff to understand. So this spreadsheet is what I call the poor man's covered call spreadsheet. It's a spreadsheet that I've created, by the way, so if you want it, you can just go into the link of the description. You should be around the first links, and it's a completely free. Just click on file, then make a copy so you can access it from your own Google Drive. So in that spreadsheet, I like to track all my trades that I do when I use the poor man's covered call strategy. And there is a credit section and there is a debit section. The credit section is for everything that you receive. For example, if you sell shares, then you're being credited money. That transaction would go in the credit section. However, if you purchase, for example, a LEAP options or shares, then you're going to pay money. So it's a debit. So that would go into the debit section. And you can see here that I've written BTO call, meaning buy to open call. And as a reminder, if you don't know this type of acronyms, there are plenty of definitions down below that you can find. So in case you don't remember, they're all there. And you see that I've put, for example, the 122 strike option, the LEAP option that is going to expire in June 2022. You see that I would pay $17 in terms of premium, so $1,700. And I've chosen to sell a call so as to reduce my cost basis, so as to show you the potential compared to a normal covered call and the advantage of using LEAPS instead of buying shares. So I decided, for example, to sell the 130 call. I would collect $2.70, so $270 worth of premium that I would get credited within my account directly when I sell the option. Because know that whenever you sell an option, the premium is directly credited to your account. And regardless if you get a sign after or the option expires in the money, you keep that premium within your account, unless if you buy it back at a lower price or a higher price. And what we see here in these blue boxes, I've made this so as to really see the difference between doing a normal covered call and doing the poor man's covered call using a LEAP option. And what we can see here is the last price for Apple, so $121 per share. The latest LEAP bought is the premium, so $17 worth of premium. That's the LEAP that we're going to buy, or at least in this example. The latest call sold is the premium that we receive by selling the call. What we see is that by buying a LEAP and selling calls against it, you are making, for example, on that trade, a return on investment of 15%, almost 16%. Compared to if you were buying 100 shares of Apple and you were selling the exact same call, you would only make a return on investment of 2.23%. And essentially, by buying that LEAP instead of buying the 100 shares, you're making a buying power reduction of almost 86%, meaning that you save 86% of the money that you would have spent if you had bought 100 shares. So that's quite nice. So you see that there is a massive advantage in, for example, using LEAPS compared to buying 100 shares in the case of the poor man's covered call and the covered call. You see that you're making a great buying power reduction. I mean, it's crazy when you see that you're paying 86% less by buying that LEAP compared to buying the 100 shares. However, remember what I said at the beginning about the time decay. When you buy an at the money LEAP option, then you're going to have a lot of time decay because there's going to be much more extrinsic value, and you're going to lose quite a lot of value because of that time decay over time. So that's why personally, when I use, for example, the poor man's covered call, I like to go for deeper in the money options. That's why I was talking about deep in the money options and the extrinsic value, the very small extrinsic value that you have. Because even though you pay more money in terms of premium, when you put more money on the table at first, you're going to pay less extrinsic value, which is going to hurt you less on the long term, all things equal, of course. And for example, if we change our 122 strike to the 80 strike to the deep in the money option, and I was paying around $44 worth of premium, you see that now I'm going to only make a return on investment on the poor man's covered call of 6% compared to the covered call of 2%. But you see that I'm still making 3 times more the return on investment by using the poor man's covered call compared to if I was using the normal covered call. And honestly, it's quite a lot. And in terms of buying power reduction, before we were at 86% buying power reduction, now we are only 60, almost 64%, which is still amazing. I mean, you're still paying 64% less, and now you're in a position where you're not being affected by the time decay as much as before, and you can really last a lot longer because you're not going to lose as much value. We saw that out of those $44 worth of premium, you only have $1.35 worth of extrinsic value. So that's quite interesting in terms of time decay. You're not going to lose as much value on a daily basis, and that can really make big differences, and that's personally how I trade. If you want to see more examples on the poor man's covered call, because I've literally summarized it quite quickly and I didn't necessarily go into too much details, I didn't show too many examples, I've made a video on the subject. You'll find the image here of the thumbnail, and I'll put the link in the description of the video if you want to watch it. I hope you enjoyed that video where I talked about the leaps. I tried to show the advantages, the risks of using leaps, for example in terms of time decay, and you see that it's quite important to understand how the extrinsic value works, how the time decay works, because when you start understanding this type of things, this type of mechanics, you can really start playing with the options and start putting yourself in better positions. For example, compared to buying an at the money leap option, you could, for example, buy a deeper in the money option so as to reduce the effect of the time decay on a daily basis. That's this type of tricks that I think are really worth to learn, because when you understand the option mechanics, it really becomes easier when you trade options after that. If you have any questions, please don't hesitate to put it in the comment section. I'll be happy to answer any question that you might have. As I said, the link of the spreadsheet will also be in the description, so if you want it, feel free to get it. The only thing that I would ask in return, if you like that spreadsheet, is to drop a like on that video and subscribing to my channel. That's really the best support you can give me, and I'd greatly appreciate it. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.